Thanks for tuning into this conversation with Mr. Jayant Acharya of JSW Steel. They've come out with the numbers, and when I looked at the numbers vis-a-vis the estimates, single-digit growth, largely on expected lines. The question really is, what does 2024 hold in store? And that is what we'll request Mr. Acharya to talk to us about. Good having you, Mr. Acharya. Thanks for taking the time out. I hope all is well. Could you sum up the quarter and the calendar year as well, because it was marked by a slowdown of one of the key markets in the global commodity space, that is India, but also marked by some interesting expansion plans that companies like yours have put in forth, albeit you've brought down the capex target or capex amount for FY24 by a couple of thousand crores.
Yeah. So thank you, Niraj. Happy to be here. I think if you look back at the year 2023, globally, it went better than what we expected in terms of, although it's marginal, 2.7% versus world growth of 3%. I think US has done better than what was originally expected. They have averted a recession. We see broad-based improvement on the inflation side across regions. So therefore, the interest rates are likely to correct. And that's a view from most of the central banks as we go into the 2024. And that should be positive, basically from consumption, construction, infrastructure, and manufacturing space. If you look at China has had some difficult period last year. The property sector has been weak. However, they could balance it with the growth in other sectors. Infrastructure, manufacturing, their automotive especially has done very well. And that could balance some of the drop which the property sector put up. We see some targeted stimulus in China. They've already done a targeted stimulus of 1 trillion in October. We are hearing that there will be a targeted policy action in the first half of this year as well to support and recover the economy. That should be positive for the world at large. If you look at the steel space, China had a subdued demand. The production was flattish year on year. The China demand was subdued, so therefore the exports went up into the world, and that did cause some turbulence in the international markets. Having said that, we see that now with raw material prices having gone up, the margins are under strain in China as well. So we see international prices have moved up in the last few weeks, and it has moved up in China as well. So we expect that there will be some moderation in export. There will be some improvement in the domestic demand as we go along. India has done well in the on the economic growth story. Our momentum continues to be strong, in excess of 7% growth this year, and expected to grow at about 6.3, 6.4% next year as well, the fastest among the major economies in the world. We see a concerted action on public capex holding up in the next year as well. Manufacturing in India and Make in India focus has paid good dividends. We see movement in energy transition doing well. Automotive is doing well. So therefore, an all-around India story is at play. And we see that that will be very good for steel consumption overall in the country at large. In the shorter term, there has been some stress because of imports which have come into India in large numbers in the Q3. And that has caused some kind of strain in the market. But with better global prices now, we expect that the India prices in the coming months will also improve.
Okay. But be that as it may, could the threat of imports still stay, or does it still stay large, Mr. Acharya? Does it impact the India ops in a meaningful way?
So if I were to look at the positive today, let me start with the challenge. I think in the month of October, November, and the quarter October, December at large, we saw higher imports. The imports into the country were at about 2.6 million tons, and our exports fell. So imports grew by 16% quarter on quarter, and the exports fell by 16% quarter on quarter. And that created a net import scenario of 1.2 million tons in India. Having said that, from the last few weeks, we have seen prices globally have moved up, actually from December onwards, and that has opened an export window. And with some price corrections which have taken place in November, December, I think the domestic prices are now at near parity to imports. So therefore, in Q4, as we see today, your export volumes from India will go up. The imports are likely to be limited, and a seasonally stronger quarter should augur well for demand at large in India.
Okay, and just one quick follow-up there. By and large, as things stand currently, and who's to say what's happened 3 months out, but is the input cost largely balancing out the fall in the selling price, if you will, impacted due to the imports, or are there some pressures that you foresee in Q4?
So in Q3, we had higher cost of we had higher cost of raw material, both from iron ore and coking coal perspective. Coking coal, our cost increased by $21, and iron ore prices also went up. So that did put pressure on the margin. While the NSR went up to some extent, but we did see a drop of about close to 475, 480 rupees per ton in terms of quarter-on-quarter drop in margin. However, going into Q4, we see that the coking coal and iron ore prices remain elevated. So therefore, they will put some pressure on the margin. But we see better volumes on the back of stronger exports from India. Since global prices have gone up, the price realization as well as the export volumes are increasing. The imports will get limited. We expect that prices in the subsequent months in this quarter in the domestic market could also improve. So that should augur well for increase in volumes, which will, and also a better balance, I would say, between mix, export, domestic, and the product mix, which would partly offset the increase in the cost.
Okay, it's actually the other way around. I was asking you exactly the opposite, and it's actually the other way around, wherein the costs are higher, but you believe maybe higher volumes and a better product mix could help you offset some of these costs as well. That aspect on capex, you've largely been confident around, and I'm not saying you're not right now, but you've largely been confident around the capex that you're putting up year after year. There's this, the planned capex maybe lower by 2,000 crores this year. Is it more a factor of timing as opposed to intent? Part one of my question is that. And part two, any updates on capex as well as fundraise for the capex?
Yeah. So on the capex, Niraj, we are on track. Our expansion projects are on track. We, in the Q3, we spent more than 5,200 crores in the quarter. Our overall capex for 9 months is about 13,250 crores. So by and large on track. We expect about 18,000 crores overall capex. It's mostly just a timing issue. So therefore, I think our expansion projects and everything is getting funded in appropriately. From the fundraise for the next year, we are looking at raising 2,000 crores through NCDs, and we are taking some enabling approvals in the board to raise some funds to refinance some of the debts as and when it may become necessary in terms of rupee loans in India.
Got it. You mentioned about the manufacturing, at least the government capex and the global interest. Now my question is, over the next 18 months as some of your major capacities, or the next 24 months as some of the capacities come on stream, get commissioned, so on and so forth, do you expect a confluence of government capex remaining steady or maybe coming lower, who knows, due to fisc consolidation, but balanced out by the higher private capex in India and higher interest in manufacturing on the global side as well to show up? Could that happen? You've recently were at the World Economic Forum as well. Give us a sense of how do you see the India interest and what could it mean for steel demand for calendar year 24, arguably the next 24 months?
So I think from a medium term perspective, India looks very good. The remaining years of this decade should be very good for India economically. The growth trajectory is going to support steel consumption in India very well. And therefore, we remain very positive on our capacity expansions in India. While in the World Economic Forum at Davos, I also was happy to see that 5 states were represented very strongly by the senior ministers of the government, and central ministers were there as well. There was a positive, I would say, positive feel about investing in India by many global companies as they see a growing market in India in the coming years. Our capex story, therefore, remains on track. We are completing our project at Vijayanagar expansion of 5 million ton. Our phase 2 expansions in BPSL in Jharsuguda are also getting completed in this quarter. We are directionally on our track to achieve about close to 37 million tons by FY25 in India. And we will continue to look at brownfield investments to go up to 50 million tons as we indicated last time during the course of this decade. Specific cost of investment in brownfield is lower, and we will focus on Vijayanagar, Dolvi, and Jharsuguda in our journey of brownfield expansions, though.
And any change in the timelines as earlier envisaged when it comes to any of these capex plans coming on stream, Mr. Acharya?
No, Niraj, we do not see any change in the timelines. What we have to keep in mind that 6 to 7 million tons of additional capacity will come into play in the next year, partly going into production because of ramp up in the next year. But that would generate additional volumes and additional EBITDA for the company. And we are quite confident that we'll be able to fund the capex growth plans which we have undertaken in this decade.
Okay. Mr. Acharya, one final question. I see a lot of people who are tracking this space, not necessarily as Excel analysts, but talking about how just the capacities coming on stream for you or for some of the others, but let's take you as an example, being a prime indicator of one, the business confidence, but two, the quantum of growth that could come in, ceteris paribus, of course. I'm just trying to understand, as you were setting up these capacities, is there also this belief about utilization levels because of the growth in India and the global interest, and therefore could growth for JSW Steel be commensurate to these capacities coming on stream? Because usually it'd be a factor of capacities coming on stream, but also the ramping up of the capacity utilization levels happening slowly and being unpredictable. Could it be a bit more predictable this time around? If you're understanding what I'm trying to ask you.
You're talking about overall capacities in India coming up?
Yes, please.
Okay. So I think if you really look at a slightly longer scenario, as we maybe discussed last time, we are looking at a production and a demand, let's say, in excess of 200 million tons by the end of this decade. Which means today, this year, we will end maybe close to 134-35 million tons of demand in India, which would mean maybe an incremental demand of 65 to 75 million tons of steel in the remaining 7 years to go up to FY31. That is something which is very much doable. If you look at a 10 million tons of incremental number, I think even if you get an 8% growth, our belief is that 8 to 10% growth in the medium term is a very doable thing. We should be generating anywhere between 12 to 15 million tons incremental demand in India every year. Majorly, capacities in India are such that they are focusing more on the domestic demand, and that is what these numbers also mean. Our exports from India will probably be less of direct steel and more of engineering exports as we develop our engineering capabilities and look at the supply chain rebalancing from China to other countries, including India. So good opportunities in the medium term. We do not see in the next few years capacity expansion as a bottleneck. Actually, it is a need to look at the economic growth in India.
Got it. Mr. Acharya, we leave it at that. Thanks so much for taking the time out, and all the best for the year ahead. Much appreciate your time.
Thank you very much, Niraj. All the best.
Thank you. And viewers, thanks for tuning in.